We've all had that dream, right? Finding that one tech stock that doesn't just climb, it launches. We're talking a 10x return. But let's be honest, it usually feels like you're just buying a lottery ticket. So what if you could swap that gamble for a clear, repeatable framework? What if there was a way to tune out all the hype and see what a company is really worth? Well, that's exactly what we're going to break down right now. All right, so here's the game plan. First, we'll dive into that 10x dream. Then we're going to draw a really important line in the sand between a stock's price and its true value. After that, we'll unpack the formula itself, see how it works with a hands-on example, and then wrap up by showing you how this whole way of thinking can become your biggest advantage.
So, first up, the hunt for 10x stocks. We've all heard the stories about the folks who got into Amazon or Nvidia super early. I mean, that's the dream. But here's the problem, the dilemma, right? In a market that's just screaming about the next big thing every single day, how do you tell the real game changers from the duds?
Let me ask you this. When you imagine a stock that's about to 10x, what comes to mind? Is it the slick new product? The ads that are everywhere? Maybe a famous CEO? It's so easy to get sucked into the story, but the real lasting answer? It's almost never on the surface. You gotta look deeper, into the fundamentals. There it is, a 900% gain. That's what a 10x investment looks like. But here's the thing. Just chasing this number blindly isn't investing, it's gambling. The real trick is finding companies that have a believable, a plausible path to get there. And to do that, you have to learn to ignore all the noise. And that leads us to maybe the most critical skill of all, getting beyond the market hype. It's all about learning to separate the chaotic, up and down noise of the stock market from the clear signal of what a company is actually worth. This slide just nails the constant battle every investor faces. Over on the left, you've got the market price. It's all about hype, emotion, and what was in the news 5 minutes ago. Think of it like a house's curb appeal. But on the right, you have intrinsic value. This is the foundation, the plumbing, the stuff that really matters. It's what the business is actually worth. The real secret to success is learning to buy houses with rock-solid foundations when, for whatever reason, their curb appeal is having an off day. So let's put a pin in it. What is intrinsic value? It's an estimate, and that word is super important, of what a business is truly worth based on all the cash it's going to generate for the rest of its life, completely separate from what the market is feeling on any given Tuesday. Look, this isn't just some textbook definition, it's a total mindset shift. It's the moment you stop thinking like a stock trader and start acting like a business owner. So, how do we actually figure this stuff out? Well, we use a formula. And no, not some crazy math equation, but a framework. A step-by-step process that's designed to give you clarity and confidence, especially when the market is going haywire. Now, before you start picturing insane spreadsheets, let me be totally clear. This formula is really a mental model. It's a structured way of thinking, kind of like a pilot's checklist that makes sure you're asking all the right questions about what really makes a business successful in the long run. And here it is, the 4-step framework. It's pretty straightforward. Step 1, understand the business. You have to know what problem it solves. Step 2, assess its moat. How does it protect itself from competitors? Step 3, project future growth. And you gotta be realistic here. What does the next 5 to 10 years look like? And finally, step 4, calculate a fair price. After all that, what are you willing to pay today for all that future potential? Okay, theory is one thing, but let's actually put this thing to work. We're going to apply the formula to a made-up company. Let's call it Future Tech Inc. and see how this framework helps us think things through. So here's how you can turn those steps into a real research checklist. For understanding the business, you look at something like the total addressable market. Is the pool of potential customers getting bigger? To assess the moat, you look for things that lock customers in, like high switching costs. For growth, you want to see a track record of strong, consistent revenue growth. And finally, for a fair price, you could compare a metric like price to sales against its growth rate. Now remember, this is a thinking tool, not specific advice, but it's an incredibly powerful way to organize your thoughts. So what's the big payoff for doing all this homework? It's your new investing edge. This whole process changes you from someone who just buys stock tickers into a true business owner, someone who's investing in an actual company, not just a blinking light on a screen. All right, if you take away nothing else, let it be these 3 things. Number 1, focus on what a business is actually worth, its intrinsic value, not its price today. Number 2, use a system, a process to cut through all the noise and the hype.
And number 3, never forget that patience is your superpower. Real value gets built over years, not days.
Let me leave you with this classic piece of wisdom that just says it all. Price is what you pay, value is what you get. Your entire job as an investor is to find the gap between those two and to always make sure the value you're getting is way more than the price you're paying. So the real question isn't, what hot stock should I buy tomorrow? The question is, how will you change the way you look at things? Now that you have this framework, where are you going to start looking for that hidden value?